Hello, everybody. Today is November 15th, 2024. It is Friday. I am joined here by Astronaut Toad. Go ahead and say hey.
Good evening, everybody. This is Astronaut Toad, and we are excited to talk about ICT tonight.
In the absolute bare bones way to read a chart. It's the title of our video today. Um, if you guys want more access to this kind of stuff, go to cartoonmoneyprinters.com. We are now doing just a 30-day free access. So come get 30 days free access. See if you like our tools or indicators, and join the community. See what's going on in the Discord. We got a lot of good people in there, a lot of good traders. So yeah, Astro, why don't you go ahead and we'll just jump right into it.
All right. Well, whenever we get a new trader in the group in our Discord, there's always like, where do I start? And I think this is the best place to start, because when we trade like inside our Discord or just on our own personal, we have various different strategies that we use that are definitely advanced stuff. And I don't feel comfortable just diving right into the deep end of like, oh, here's this indicator. And, I have to explain like 5 different things of what our indicators mean, what strength and momentum and RSI or the squeeze or a gap or I can't explain average true range or standard deviation or whatnot without first giving everyone a basic understanding of just looking at a chart and knowing what is happening. Okay. And what I've noticed is that the most common, most popular strategy these days in crypto and in, stock market futures and whatnot, the vast majority, I dare say, avalanche or landslide of online education out there is ICT or inner circle traders. What's the guy's name? Michael J. Huddleston. Basically, this guy invented concepts that allow you to speak a language that the market, it's the language of the market. And there's a ton of stuff that ICT teaches, ICT himself and dozens of other quote unquote famous YouTubers or streamers who all have their own way of seeing the market. And they've all got, their acronyms of like order blocks, fair value gaps, buy side liquidity, sell side liquidity, inverted, displacement, this, that. There's so much stuff that's just like, it's just a language that you use to understand what's going on. And so what I realized is, let's just break it down to the most simple chart reading skill. And I want everybody to think of reading the chart as a skill, not a strategy. ICT should be seen as a skill for chart reading, not necessarily a strategy. We will get to a strategy where you can take trades, but I don't even use ICT to take trades specifically. I use our indicators and our other methods that have a known edge. ICT, as far as I know, every single public ICT trader, including ICT himself, does not share their actual public P&L of their account. So you don't know if any of them are actually profitable. So keep that in mind. and treat ICT as just a way to read a chart. And then on top of that, you add your strategy, okay? So let's dive in. The first thing you see when you look at a chart is all of this mess. All right, I'm gonna maximize this. We are on, this is trading view. I'm on the 4-hour chart. I'm gonna go to the 1-day chart, the 1-week chart, 1-month chart. So here, this is 2021, where those all-time highs were, right there. And then now here we are, this is 2024, starting right here, where it just did all this nastiness. The question is, what does it all mean? What do you do? What do you look at? So here's where you start. You start by just looking at the most recent candles and say, what do I see? What is going on here? Right now, on the monthly chart, actually, I should make these, I've got white and gray candles instead of green and red. Let's see if, just for y'all, I'm gonna switch to a very, very faint green and red. Is that manageable? Okay. What do you see on the chart? This is the most recent few candles. You see these 3 sizable green candles. So the question is, on this monthly chart, what do? You do nothing, because all you've got is this one big candle sticking up here in the middle of nowhere. That is the core concept of reading a chart, is called market structure. What do you have right here? You have no market structure. You have a candle sticking up into thin air. You don't know if the next candle is going to go straight up again, or if the next candle is going to come back down. So on this scale, the monthly scale, you have nothing to do. If you bought at the opening of this candle down here on October 1st, you could sell right now. That would be fantastic. Other than that, you got nothing to do. Okay, so then we go down to the weekly chart. Same thing. The last 3 weeks are big green candles, nothing to do because you're sticking up into thin air. If you bought back here 3 weeks ago, you could sell some right now because you're in massive profits. Other than that, you've got nothing to do. Now we're going to get to market structure here, because this is the first chart. If I go back to the monthly chart, look at these candles. All I've got is one a red candle, a green candle, a red candle, green candle. There's nothing really going on here, except I've got this high, and I have a lot of presets that I like to mark stuff with. I'm just calling this 1 month. And then I've got this low. That's another monthly low. I'm going to call this a range because price clearly spent 1, 2, 3, 4, 5, 6, 7 months stuck inside this range. Okay. So inside this range, there was a lot of people losing money and a lot of people making money just by price going up and down, back and forth. Then price broke above this high for the first time, and this candle still has 14 days in it. But if this candle were to close way up here, that would be significant, because it would be the first candle in this whole long way that it just absolutely smashed through this range. This is another ICT concept that isn't really an ICT concept. It is just basic chart reading. This is, they call it displacement with momentum, or you could call this a break of structure. This is your structure from here to here. This whole box that is your range for this time frame. You are stuck inside this range. This breaking above it is a break of structure. But there's nothing to do, because even on the weekly chart, let's look at this on the monthly. On the weekly chart, you could do something in between here, but now that you're way up here, you got nothing to do because you don't know where price is going next, okay? The only important thing to note is that price smashed through this level and just absolutely ripped right through it. In fact, we have the first thing that is the core ICT concept, and that is a fair value gap. What we have is these three candles are all the same color, which is nice, but not necessary. And this middle candle, price only traded within this range during this candle. The wick of this candle, this last candle, creates a low right there, and then the wick of this candle creates a high right there. So this is a fair value gap on the weekly time frame. I'm going to mark that out as 1 week. This is a sign that price is really, really strong. Everybody's bullish, and it is likely to continue because it destroyed this range. And basically what you want to think to yourself is, everybody that bought and sold in this range is exhausted and they're done in this range. Now we are going to establish a new range, likely up higher. But you don't know if price is going to go up here and do this. You don't know if price is going to go down here and do this. You have no way of knowing yet, okay? All you know is that price left this range, so it is likely to go higher because it broke up above with this massive gap. Now, again, there's still a day and 22 hours left in this weekly candle. It could shoot straight back down to 80,000, and it would still be, this candle closed, it would still be a strong bullish break of this market structure. Okay. So what are we looking at in this range? What you want is, what you're all hoping for is, how do I actually take a trade? Well, here's what you do. You go to the biggest time frame where you can actually see 2 consecutive candles, or at least 2 candles that are counter trend. So on the monthly time frame, I've got 3 red candles here. They're not consecutive, but at least this one closed lower than this one and had a wick way down here. So that's why I'm calling this a range on the monthly time frame. Okay. Then it broke, it smashed up above here, but it's not closed yet, so that's not done. Then going back down here, we've got these 2 candles here make this a low here. So that's another, this is the most recent monthly low. This is how you draw market structure. You're looking for at least 2 counter trend candles, and then that is your new range. So just looking at this, you can see after price broke above this level, let's see, where's the high? Right there. After price broke above that level, wow, it didn't come back. It just absolutely ripped through this level and went straight up for 1, 2, 3, 4, 5, 6 months before you had a red candle. Then it went 1, 2, 3, 4, 5, 6 before it 7 before it broke out of that range. So you've got these periods of 5, 6, 7 candles where it's pumping and then it's pulling back. What do you do to find a trade? Well, right here, you do not buy right here. this is a question that I've been getting a lot because, especially in crypto, it's getting popular again, so everybody's getting interested. So you're going to get those phone calls or text messages from the random friend who's like, hey, I heard Bitcoin is cool again. Should I buy some? And you sit those friends down and you show them this chart and go, if you buy it right here, you could be buying a top. And as you can see, or right here, it went down 1, 2, 3. You had a pullback there, 4, 5, 6, 7, 8, 9, 10 candles, red candles after this high. Massive, massive tumble. I did have a friend call me up because he bought right about here. And I was like, yeah, congratulations. You're finally back in the money after 3 years of waiting. Anyways, what do? You do not buy right here, nor do you sell blindly, okay? Because it could shoot straight up from here. The basic concept of ICT and all trading in general, not just ICT, is you want to wait for an opportunity that is favorable to you. And either longing or shorting right here on at least the monthly time frame is a terrible idea because you've got nothing to go on. So what we're going to do is we're going to wait. And this is the next basic concept of ICT. And that is...
real quick, sorry to interrupt in your lesson, but I was wondering, do you mind just doing a brief little mention on the psychology and the emotional aspect of something like that? Being in this...
Yeah. This is very important. And this is the number one mistake that most beginning traders make. And that is they see it going up. They see price shooting up through to the moon, so to speak. And they buy. Because you should assume, because it bashed through this level really strongly, it is smart to assume that it is going to keep going up. However, you do not want to buy here because that is an emotional decision that is I dare say, a dumb decision. Nor do you want to short here because you're just thinking that you're smarter than everyone else. And being like, oh, it's gonna reverse here. Either way, if you think you are smarter than everyone else, you are wrong. So that's rule number one, is you do not want to be buying or selling when you are emotionally charged, thinking, oh my gosh, it's going to go to the moon, or oh my gosh, it's going to absolutely crash. You want to be waiting for everyone to be thinking the opposite, and then you can consider doing something that the majority of people are not thinking of doing, if that makes sense. So what we're going to do is we have drawn this market structure. This is on the monthly scale and on the weekly scale. Well, on the weekly scale, what we have is this right here. From this, so here's how you draw the monthly range, because on the monthly chart, remember, you've got nothing but this. So I'm going to draw a Fibonacci tool here, and I've got a preset for a monthly range. Oh, that's annoying. I don't have my labels. I'm going to cheat and make it weekly. No, that's that will not do. Let's see here.
Yeah, there's a serious psychological like FOMO if you may feel like you left the station. Are you there?
Yeah, if you're feeling like the train is leaving the station without you, that is what all the smarter traders want you to think.
Mm-hmm.
And let's hide these ones.
And there's always an opportunity to trade. You just gotta know what to look for, and not get emotional when you're trading. When you get emotional, you make mistakes, and then yeah, you'll get upset. You'll get angry when you start getting into the red. You want to avoid that whatsoever and get into the right side of a trade.
If you are feeling jealous or scared or anything, any of those emotions, then you automatically have to step away from the chart and say, okay, what do I do? And this is actually leading right into what we should talk about now is, what do you do when you see price up here in this crazy pump? This is the next basic concept of ICT, and that is you wait for price to be scaring other traders and giving you a good deal on the trade, okay? So we've drawn this market structure, and this is where it broke above. So this is a monthly BOS, a breakup structure. But we cannot go long just by buying this top, because this is the whole entire monthly range. What does that mean? That means that on a monthly time frame, so for the next 6 months or something crazy like that, price, what could price do? Price technically could stay bullish and go all the way down here towards this swing low, do this, and then go all the way back up here, because this is your monthly range, and all of this would still be bullish. And if price comes down here, I guarantee you everybody's going to be freaking out and getting bearish. But you know, based on the monthly time frame, that as long as price is above this low, you should still be bullish on the monthly time frame. On the weekly time frame, you can see we've got some internal market structure here. And then there's a couple of candles here, but these are single candles, so I'm probably going to call them daily market structure, but we'll get to that. But here's what I'm seeing is on the weekly time frame, this is my new range. So price could go all the way down still to this low, and even on the weekly scale, it could be bullish. What do we do to find an actual trade? The basic premise of ICT and all trading in general is you want to be selling a high or buying a low, which is measured by at least this middle 50% retracement, which is called equilibrium, but you can call it anything you want. It's a 50% retrace. So if you are wanting to go long, your trade opportunity has to happen below this equilibrium level. This is where you look for a trade, and this discount is at the Fibonacci 0.618 level. So I prefer to find my trades in this range right here. You could find a trade all the way down here somewhere, but I would prefer to find my trades in this range. That's a basic concept of ICT that is way overcomplicated. And that is, where do you look for your trades?
Sorry to interrupt. I got a quick question for you. Why did you choose the swing low to the swing high when you pulled that fib or premium discount equilibrium? Why did you not
Uh,
choose the last two green candles as opposed to all the way at the bottom there, and not even the candle before that prior at the monthly bottom? Can you
hold on,
explain
let me see.
your thinking behind that and what led you to pull your fib from there essentially? Your range?
Yeah, let me start hiding things so we can keep it all really simple here.
Yeah.
See.
Because if yeah, just the absolute bare bones way to read a chart. If they don't know how to pull this basic range fib tool, they might have um this will help them. Is the reason why I'm asking.
Yeah. Okay. This is a subjective thing that every trader does differently. So there isn't a truly correct way of doing it. And I want everybody to get that out of their head, because there is no right way. There are multiple right ways to do it. What you should prioritize as a trader is doing it the same way consistently every single time, because that is the only way you can build trust in your system. Let's analyze this price action here. Okay, what do we have? My market structure that I was talking about, I look for the high. This is obviously a high. I called it a month, and then this is a low. But then inside this range, I'm looking for at least 2 consecutive candles in the same direction. So that means that right here is an internal structure. Well, we're on the weekly time frame, so I don't think it's not internal yet. Well, actually, let's see. Yeah, because the most on the weekly time frame, this is my actual move. So here is my old weekly range from here to here. That means that price can do whatever it wants in this whole entire range, and it is internal. This is a high here that it doesn't break a high or break a low, so it is internal. And then you've got this here, and then you've got this here. All of these levels are internal to this range. I'm going to go back to my gray and white candles because this is driving me nuts.
And fine. And I do also want to point out that this also fits in candle range theory. So, as Astro was saying earlier in the stream, all these different traders are coming up with all these terminology that are effectively the same thing. So, a lot of people get lost in the language of trading, and they get upset with each other because they're like, "No, my word is better than your word." But in actuality, the numbers don't lie. The candlesticks don't lie. It doesn't matter what you call it. This is just a function of the candlestick pattern that people have seen that is has proven them success.
Yeah. So let's go over the whole idea from top to bottom and just see if we can find a trade. We've defined how to read the chart, and that is we're going to look for highs and lows that have at least 2 candles of the same color, and that is a range. 2 candles of the same color in the counter trend direction. So for right here on the weekly time frame, this candle right here is not part of this range, nor is this one, because it's just one candle, and it doesn't need, sometimes I'll give it to it if it's one candle, but it like retraces like 2.5 of the previous candles. I'll give that the range. But that's a subjective measurement, and that's where, you know, just doing whatever you do consistently is more important than listening to me.
Yeah.
But this is a range, okay? We've defined this range. I'm pulling it from here because internally, this is the high that was broken after these two downtrend candles in what is obviously becoming an uptrend. You don't know, when you're looking at this, you don't know that it's going to become an uptrend, but you're just measuring these levels because you've got these different levels that have at least two candles going in whatever direction, counter trend. Okay, and this is what you should be seeing in this basic concept is price came up and then it made this low, but then it made a new high. Then it took out this low and then it made a lower high, and you've got all of this stuff stacking up. Again, there's lots of fancy terminology. All you're looking for is lines that are getting stacked up. Then price came down and slashed through this low yet again. It closed up above it, and that's really nice. But it's taking out these lows. What does that mean? From a psychology standpoint, this means that people are trying to buy and they are getting stopped out, handing their money over to the bully who's taking their money as price crashes down below and then shoots back up. So there's some rich bully who's stealing your money down here below this level and then selling to the idiots who are like, oh my gosh, it's going to the moon. They're selling to the idiots up here. And then over and over again, drops down. Some people buy, some people sell because they're scared or whatever. And then it goes up. So what are we getting at? We're seeing that all three of these levels have not been taken out. Then 4 levels, okay? You've got 4 levels that have not been touched. And on this scale, you've got 3 levels that are exhausting the traders, the weak traders. When this happens, what do you have to expect? You have to expect that price is going to absolutely rip through these levels, because that is where people's stop losses are for their shorts and where they are looking to take profits if they bought down here. So the smart people bought down here and they want to sell anywhere up here. Also, the idiots that got short up here and are not taking profits down here, they are also going to be forced to get out of their trades up here as well. So that's going to create a snowball effect if price gets up here, and it's just going to shoot straight up. So that's the basic concept of liquidity. And there's a million different ways of looking at it in ICT trading concepts. That's all you're looking at, is who is getting destroyed and who is going to make a ton of money. This is your external level. It's breaking this low, it's breaking this low, and then getting bounced back up. And then it doesn't break this low, and you get these 2 up close candles. Oh man, when this low gets put in, you should be, that's called a higher low. And that is a very exciting thing. When these 2, 3 candles print and then it gets through that. Here's what you're looking for. You are waiting for price to get at least below equilibrium. So this is where we're going to look for a trade. We are going to draw, let's see, path. We are going to look for, the price may not do this, but here's what we're going to look for. We're going to look for price to just tumble down and get below this equilibrium. It might bounce off of that level because there's all these levels that are here. It might go down to discount, and then it might shoot up back to a high. This is the, and then from there, we don't know where it's going to go. So I draw the line. I always draw my lines aiming sideways, because I want to remind myself that once this high gets taken out after a retrace, all bets are off. But here's the entry model. You have to wait until price gets down below equilibrium. because that gives you an edge over other traders because your stop loss can be closer and your reward can be better. So what do? You wait for this to get broken above this level right here, and then you go long and you put your stop loss below that low, and then you target this high. Bam, suddenly you got a 2-to-1 or 1-to-2 risk to reward ratio trade. I just randomly drew that. All you have to do is look for this high to get broken, and you can see it happen here. Look at that. All right, I'm gonna hide everything. Let's draw it again.
Oh, why don't you just draw it with the line tool, that green one that you had? Just as you did before.
Here is, oh, it's quicker doing it this way. Here's the weekly level, and this gets broken above. You got this nice pattern here that is saying, hey, it made this low down here. It could not make a lower low. It broke above this level. What do? We look for equilibrium. Hey, there it is. So when price got below this low, I'm going to draw this box right there. That's where my entry was. And then I target this high right here. So are we going to be able to find an entry? I'm going to go from the weekly chart, and I'm going to skip a time frame and go to the 4-hour chart, because 1 week divided by like 10 or 20 or 30 is approximately 4 hours. And that's what we want to do, is we want to stack time frames and get confluence of all the time frames aligning. So I'm on the 4-hour chart right now, and I know that the weekly chart did this break thing here. Okay, there it is right there. Now, I'm on the 4-hour chart. I'm looking for a trade in this blue box, and it happens right here. And it just barely wicks below that level before shooting back up. So on the 4-hour chart, if you see this happen and it goes zap, price reacted to this level, and you say, hey, this is bullish. It got into equilibrium and it got smacked. Somebody lit the rocket fuel and it got zapped back up. So at the very worst, on the 4-hour chart, you could say this candle closed, it got zapped back up, and then this candle closed, and it's pretty bullish. You could put your stop loss below that low, and then target. What do we target? We're going to target the next market structure on this time frame. You'd have to take some profits there because that's breaking that. Or, well, we'll go down to an even smaller time frame. Don't worry. What we're going to target is this high right here. Hey, there you go. A 1-to-2 or almost a 1-to-3 risk reward ratio. Son of a gun. That right there, awesome trade. But let's take it one step further, and we're going to do the same thing, fractal. And this is the last ICT concept that you want to pay attention to. This, we're doing the same thing again, at least two consecutive candles, 4-hour chart. There's that high. This high gets smashed. And what are we looking for? This is my new range, because it doesn't do a 2-candle pullback until there. That's not giving me a trade. What do I got to do? This thing never gets back to equilibrium, so there's no trade to take there. What can you do? Well, you wait until you get some form of the next market structure, and then you look for your pullback. So we got nothing here, and then price just shot all the way up here. I guarantee you people are going to be making dumb decisions all the way up here, because that's where you have all these wicks. because everybody's buying the top and then getting stopped out, blah, blah, blah. You patiently wait this whole time until it makes another high, and this is your new low. Because remember, on the weekly time frame, you're still bullish. We're on the 4-hour. But hey, look at that. There you go. Suddenly, this new range made you a new equilibrium tap from this one that never got touched. Here's your old range. I'll draw that out. And then right there, I'm gonna move this up here. There's your possible entry. Or if you're, let's see, that's not 2 consecutive candles. You would probably get stopped out if you tried to trade from this range. Anyways, this is where we're looking. So now I've got that, and I'm going to go down another, what's 4 hours divided by like 10 or 15 or 20. We're going to the 15-minute time frame. If my chart can even go back that far. Yep, there we go. Same thing, same process. What are we looking for? We're looking for drawing market structure in these ranges. And then we're looking for a trade. It just, price just goes zap down into below equilibrium and then shoots back up. Very nice and strong. So if you are FOMOing into a trade, you get in after it smashes back above this level, and you go long right there, and then you have to target this high because this is your first market structure. This is your range, and so you have liquidity up here and then up here. We're on the 15-minute chart, so these are 15s. That's not a very good trade. But obviously you get to target some more liquidity. But this is what we do. And I'm just looking at my notes and see. This is what we do on multiple different time frames. And that is how you understand on the bigger time frame what are things. Let's go top down. On the biggest time frame, things are bullish. Monthly time frame, very bullish. Weekly time frame, very bullish, nothing to do. It is bullish. So this is the habit that I want everybody to get into. It is bullish, but you have no trade. You have nothing to do. What you do, if you see this chart, what you do is you draw all of this. There you go. If you see this chart, you draw this, and then my alerts got tired. You set an alert. This is called BTC down. You set an alert for somewhere around here, and then I'll just put that one up there for fun. And you walk away. If you come to the charts and you see this, you set your alert for equilibrium and you walk away. Okay. Same thing on the daily chart, except I'm going to skip to the 4 hour because I like skipping time frames in that fractal nature of, like I said, take your time frame and divide it by like 15 or 20 or 30. So we're on the 4 hour chart. Same thing. What do we got right now? Here's a 4 hour low. Here is a 4 hour high. I think I already drew this. Let's see. Let's see if I can find it. There it is. Oh no, I put it in here. Here's your 4 hour structure. It's going like this. And I would recommend drawing these zigzags out until you just get the hang of it, seeing it naturally, because drawing all the zigzags helps a trader remember whether we're bullish or bearish. So right now, just drawing out this structure, it comes up and makes this high. It's got 2 candles. There's your pullback. And then it taps that high again, but it only wicks above it and then sends it back down with 2 more candles. So that's another low. This is internal because it didn't break this low. If this had broken below here, it would not be internal. It would be external. And that would be a bearish market structure shift. Okay. This did get bearish for a little while up here because you can see right there, market structure did break below that low. So I guarantee you there have been traders trying to go short because it broke below and now it's retracing back up. In this range right here, this is your range for this break. So as price got above here, you probably had traders going short and then getting stopped out because price did get all the way back up here. But you have to remember that oh, hey, I see Minion's question. I'll get to that in a second, buddy. Good, sir. Thank you for your question. But here's what I want everybody to remember is this high is the important high. And then this low, actually, because this broke, this stopped being internal and became external. This low is the important low. Okay. This is internal and this is internal. So in between this range, you've got not much to do. Range 4H. And so if you come to the chart and you see this, you set your alerts for this high and this low, and then you walk away. Let's see, where's my low? I'm gonna hide all this. So is it an internal high or low if there are 2 consecutive candles and then it goes the opposite way again? Why did the previous external low become the internal low? So let me see if I drew something wrong, and then we will go over it.
So on the 4 hour chart, it looks like that 4 hour low is looking like an external low, even though you have an external low right below it.
Okay, so let's go back in time and see. There's my low. This is where price comes up to this level, and then you have 2 candle pullbacks. So let's pretend we are drawing. Oh, wow, that's some old market structure. Let's pretend we are drawing market structure for the first time, and all we see is these 2 candles. Automatically, we don't know what's coming next, but automatically I have to draw the pullback, and I have to draw this level, this high. All right, because it had 2 candles in a pullback. Then price comes up back to this high, but it doesn't close above it. Still, it touched the high. Therefore, I have to start drawing this as a new low because it has established a range by giving me a 2 candle pullback and then returning to the high. So now I have a range. Another candle wicks above it, but doesn't break above it. Therefore, what do you expect to happen if price gets to a high and can't smash through it? That means that there is too much liquidity above here. Everybody is selling. There are no buyers up above here yet. Imagine, ICT is kind of all about this conspiracy of an algorithm, some sort of interbank, something. I don't know. I don't believe in conspiracies. What you need to think to yourself is, with these 2 wicks, you have to assume that above this level, there is some guy or a team of scheming people with $1 bazillion, and they will sell. You cannot break this level. What does that mean? You have to expect that this low will be returned to eventually. In between this range, you are not trading the 4-hour chart. You are going, you can trade, but you have to go down to the 1 hour, the 15-minute, 5-minute, whatever. There is no way to trade this unless it breaks through this range or breaks through this range, okay? Now we're continuing and smash. It goes flying up through that range. And then we extend this 4-hour low, but we did have a 2 candle pullback before it broke. So that is an internal low because it did not break this level. And this level was just wicked before it returned to this low. Okay. So I might have drawn it. I might have made a mistake drawing it earlier, which is why I like to just delete and redraw things over and over again. So here we are. This has broken. Now I've got 2 candles, and then this candle gives me just an absolute smash after these 2 up candles. So this 1 candle here counts as another bearish candle pullback, which means I have to draw this as the new high, and I have to draw a new low, which means this is an internal level because I've got 2 up candles, and then I've got what counts as a down candle, 2 down candles, because it smashes through all of these candles. So I'm counting this as 2 down candles, and then it gets all the way down here. So there's another low. Right now, this is an internal low because it hasn't broken below this nor this. Let's see here. And then this is an internal high because it is below this main high here. Okay, so I don't know if I drew it correctly or incorrectly previously, but I might have.
And it's fine.
Here's what
the difference that I noticed was that 4-hour internal candle was an external. Yeah,
this one.
Yep, that one. That was it, I think.
So I probably drew this as not an internal. I probably drew this as a regular 4-hour low because I was just looking at these 3 candles and thinking that this smashed through right there. But let's see. Yeah, so the 2 candle rule is subjective, and it's not. Most ICT traders don't even use the 2 candle rule. It's my personal preference of just what you're going to wind up doing a lot of is wondering, well, should I count this as 1 hour market structure or 4 hour market structure? I don't know. Because you give weight to whichever market structure is the biggest. If the weekly time frame is bullish, then I want to be looking for longs on the smaller time frames. If I'm on the 1 day chart, let's see, on the 1 day, you've got no structure except this one, these 2 random pullbacks. That's kind of annoying. So that's why I'm going down to the 4-hour chart. And let's see what the 1-hour chart has. I think I drew 1-hour market structure early. Okay. Yeah, it broke above it.
All right. So yeah, that was Minion's question.
Let's see. Got all these gaps.
I only see. Oh yeah. So it counted as 2 candles because it punched through 2 levels of liquidity, I think is why he did that. So that was a momentum.
Yeah.
Momentum.
That's
candle.
That's a subjective decision. And let's just go to the 1-minute chart so that we can watch price for a little while and see what's going on.
By subjective, it means that for him, it means that like you're gonna have to make your analysis and your assessments on why you can count these things or not, and it's part of the trader's experience that we all go through.
Yeah. So this is how we're going to read a chart on the 1-minute time frame. And we're just going to see for a few minutes what happens. The 1-minute time frame is not very reliable. And so it's a good way to learn, and to learn that you got to be careful and cautious.
Sorry to interrupt. At some point, do you want to take a screenshot of your fib tool settings for that premium discount, and then we'll just pin it in crypto chat or something?
Yes, I'll do that later. Because right now I have my fib tool settings all spread out for some weird complicated shading that I do.
Yeah.
And I'll want to I'll clean that all up and post a screenshot.
I got you, Toad.
But it's just a Fibonacci tool. So for example, the 1-minute chart is nasty. But for example, just on the 1-minute chart right now, this is what I want everybody to get in the habit of doing.
I'm sorry.
We're looking at.
Can we do it on Bitcoin dominance? Somebody wanted to look at that earlier. You can do it on any chart, so and still give the same lesson.
Ooh. Well, if I'm starting with a new chart, then I got to start on my big time frame. Look at that. That's weird. That is wild. Okay, let's do it. Here's here's a high.
I appreciate that.
Here's a high. What am I on? The daily. Here's a low. Daily. Here's a high. Daily. Here's the recent low because this has got 2 candles pulling back. This doesn't count because it's not even big enough to engulf that 1 candle there. Here's the range on the daily chart. And 1 day. This slaps way down into equilibrium. Here's my box of where I would look for a trade. Basically, I try not to look for trades below this lowest purple level right there, because this is the danger zone for sure. But we're going to have to, because it just sliced back down so hard. So from the daily chart, I'm going to go to the 1-hour chart.
Wait, can you explain?
And we're going to look at this level.
If it's in the discount zone, like a lot, you're not going to look for it along there? Or you just look?
Let's see. if so, this is I'm going to change this tool here. This is the Fibonacci tool for Golden Pocket. This is a Fibonacci retracement of the 618 is a common Fibonacci level. And people love to just blindly enter trades at the 618. The 786 is your next Fibonacci level, because it's kind of halfway in between this. If price goes below this level, I could still take a trade, but it's a danger zone, and I want to prefer to wait until price either exits this level and gets back up here, or I want to wait and see if price goes down to the low and creates a wick below the low and a close above the low. I could probably find an example of that, but basically you can trade if price gets all the way down here, but I just prefer to trade if price exits that range.
Okay.
Because basically the problem is price didn't do anything at this 618. Like, it just sliced right through it and went all the way down to the 786 and closed. If I see that, I have to expect that it's going to tap this first.
Yeah.
I don't really want to trade in against a direction where price is just absolutely destroying what should be support.
And even if
that's
you
the
have
last
a big stop level, that's a lot of drawdown.
Yeah. That's the last ICT concept that I don't really agree with, and I prefer not to teach it, but you should understand it. And that is fair value gaps and order blocks and whatnot should be respected. So for example, you can call this an order block because it's counter trend, but price just slices right through it. Okay, this is an order block. This is a same type of thing as market structure or whatever. You should see price bounce off of this level because there are people that want to buy in this level. Price just goes flying right through it, flying right through it. So therefore, I'm scared to trade at this level. But let's go down a price level, go down to the 1 hour and see what happens. Oh, this is a beautiful, man. Hey, Toji, did you ask about this because it's so perfect?
I think it was, yeah, Ika.
Oh, Ika? Let's see.
Yeah, I don't know why your name is blurred out, but everybody else's name is.
Okay, so this is an absolutely perfect example of exactly what you want to see. Price did bounce off of the 618 a little bit. That's a nice little tiny bit of a reaction. It closed down below. So here's what you're looking for. This, I should change this to white. Let's see, because that is my new midline. There's equilibrium. This is equilibrium, so I can look for a long below this level, but I'm not doing a long until I have a bullish structure break. So basically what that means is these lows are getting broken and the highs are not. I've got another high here. This counts as a pullback because it's just absolutely destroying 3, 4, 5 candles in a row. So that's a new low. Then here's where it gets interesting. This low gets broken again, saying if I'm looking at the chart like this, what do I expect? I should expect it to keep going down because it's bam, 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 just breaking these lows. As soon as this high gets broken, and here's another thing. If price didn't break this low right here, this high would be internal, and breaking this high would just mean I got to waffle around in this area below this high. But since price closes below this low, then comes back up, and not only that, but smashes this level, then we are fully game on bullish. You could blindly enter a trade at the close of this candle. If you're entering on the 1 hour, then you want to be holding this trade for a matter of days. If you're blindly entering, because you need enough power to put your stop loss a whole 1% down below, which if you're at 10x leverage, you're risking 10% of your position. Hopefully your position is not the size of your whole account, but let's do it one better. We're on the 1 hour chart. What are we going to go down? We're going to go down to the 5-minute chart, and we're going to draw this range. That is equilibrium. Here's the range, 1 hour. Because look at how perfectly it pulls back into that range. I'm going to delete this, and I'm going to draw a box right here. Here's my equilibrium discount box. We are looking for a trade in this level. And I'm going, oh, why did I get percentage? Oh yeah, because BTC.D.
Yeah.
Okay, that's measured in percent. Here we are. So same thing, 5-minute chart. Ooh, is at the end of my range? Wow.
Oh no.
So here we're on the 1 hour. We are looking for a trade in this range. Son of a gun. Here it is. Same thing. This is a range. Well, actually you could, no, because there's no, this is your 5-minute. It might be somewhere else, but let's just call it that. Now, what do we do again? Draw that range, and it's going to front run it. Oh man, that's annoying. It doesn't get back to discount. When you're pulling this, what I'm going to do is I'm usually going to look for which levels are getting respected like that. See how this has 2 candles on a pullback, so technically here are some levels on the 5-minute chart. And you got to watch these levels, because you can see when you draw this range here like this, that golden pocket gets perfectly respected from these pullback levels. So here on this scale, when it bounces off of that and it gets up above these levels, then again, you can just blindly get into a trade because you're targeting a much higher level on the 1 hour. You're going all the way up there. And then your stop loss is below that low. That's a fantastic trade. So yeah, I switch between the golden pocket and the equilibrium discount presets that I use on the Fibonacci tool. But let's go back to the 1 hour.
Minion, we'll do that. We'll do that together. Not during stream, but we'll do that after the live stream is done because we're streaming to places. Yeah.
So here's the deal. On this 1 hour time frame, I created a trade with this tight of a stop loss entry, and I targeted that high. All because the only way I can get into this trade with such a tight stop loss is if I know that the 1 hour has given me this same bullish break on this time frame, on this bigger time frame. And then also, what were we on the daily?
I think so. You went daily 1 hour.
So this is the craziness of fractal nature of charts. You started on the daily chart and said, okay, what's going on? We're now on the daily chart. We are bullish because things are just raging upward. So above this level, I should stay bullish and look for longs. Then you went down to the 1 hour chart and you said, okay, in this range, I am looking for longs. And then when on the 1 hour, this high got smashed, then you're fully bullish. Then you go down to the 5 minute and do the same thing. And by the time you are down, I don't feel comfortable blindly entering trades on those bigger time frames. But if you're down to the 1 minute or the 5 minute chart, I feel more comfortable blindly entering trades. But you can do that one of two ways. And this is the sweet, sweet amazingness of once you have perfected finding the level that is super important, and it gives amazing risk to reward. And that is, on the smallest time frame, there are two different ways you can blindly enter a trade. You can wait for a level. See these pullbacks broke below and then broke above. So I'm calling this the level on the 5 minute time frame right there.
Maybe we shouldn't call it blindly entering a trade. I'm sorry, I don't mean to be.
Yeah, it's let's see, to put it more sensitively to blind people. Let's say FOMO. I want people to understand, if you are entering a trade like that just at the close of a candle, you kind of are having FOMO a little bit. Say, for example, you're just waiting for price to smash up above this level and you're just entering the trade. That counts as FOMO because you are not using market structure on this particular time frame. You're doing it because you've used market structure on the 1 hour and the 1 day time frame. Now you have the validity to be like, okay, I'm going to just go into this trade right now. However, it gets even better. There is a better way. Here's your second choice. You see this level retrace up here, and put all that. You draw this range from the most recent major pullback, and you just, quote unquote, with FOMO or blindly or whatever you want to call it, you just put a limit order at that 618 and target that high, and then you put your stop loss below that low or below the set or around the 786, because if it gets, remember, like I said, if it gets down here, it's probably going to tap that, and then all bets are off because it might go way lower. But this is knife catching. You put your entry as a limit order at the 618, and then you just go for it by targeting this high, because you get your entry right here. Within 30 minutes, you are covering your trade. You're taking some profits. No, 25 minutes. In 25 minutes from entering the trade, you are in profit. You've taken profits to cover your trade. So you could either close half your trade and leave your stop loss down here, or you could close, 25, 30, 40, 50, 60% of your trade and move the stop loss to break even, or put it below whatever low gets made here. You put your stop loss below that low right there. Oh, I can't do it because I'm down to the decimals of BTC.D. But that right there is a pretty crazy risk reward trade when you catch that knife. Then, where were we targeting? The 1 hour. Oh, this is going to be juicy. Hey, there's my favorite number. There's a 1 to 42 risk reward trade. You're only going to ride like 10% of your position is ever going to get here as a runner. Okay. But that's exactly what you do is you enter like that, you're targeting that high, and then as price pulls back, when price breaks this level here, then you could move your stop loss to below this level. Okay. So you're locking in a lot of profits as price just keeps ripping. You could also just let it go forever and do the same thing and say, okay, price got up here. And then so I'm going to put my stop loss below this low. And then eventually you get stopped out because it gets internal and then it gets here. But it might have just kept going and you could put your stop losses below these lows.
That's a new range. It's a new trade setup. Right?
Yes. However, on the 1 hour / daily, you have passed back out of discount into premium. Mm-hmm. So if you were to go long here, you could go long. That's definitely an amazing trade on this 5-minute time frame. Well, let's see if it gets stopped out. No, hey, there you go. Look at that respect, nice respect of the 618 and the 786. So that would be a nice blind entry or a FOMO entry. Put your stop loss below that low, target that high, 1 to 2-ish risk reward ratio. And there you go. But again, I don't want anybody, and this is probably the downfall of almost everybody who tries to trade ICT, and that is you master looking at the charts, you know, like you're saying, okay, hey, I'm good at finding market structure now on the 15-minute. Let's do it. There's your high. There's the recent high that gets broken. This high gets broken. This low gets broken. This is internal. Bam, price goes down, slices through that. What do you do? Do you go into a short here and target this low? You could have done that. But blindly entering a trade or foolishly entering a short trade there, you would have to put your stop above that high and you'd have to take profits here. You're at a 0.46 risk reward ratio. This might shoot down all the way to this other low, but you can't trust that. You have to take profits on your market structure. So that's why if this happens, you have to patiently wait and say, okay, I would have waited until price got up to the 0.5 on this time frame, and then I could just enter right there, or the 786 of that range, actually. Let's see. Yet another, oh man, BTC dominance is not having a good day. Here's my last Fibonacci tool, and then we'll call it a night.
Okay.
You could say, I'm going to just enter a trade off of this and put that stop loss above there and put that target down there. But that trade never happens. There's a whole lot more of, there's too much more concepts in ICT for anyone to worry about mastering all of it. For example, I could say, in hindsight, the reason that price didn't come back up here is that it respected this fair value gap But here's the big problem that I have with ICT. Everybody's always cherry picking their examples and saying, well, you know, this fair value gap did its thing, so it's bearish. Well, you can't even look for a trade until price gets above this blue line here, because that's your premium discount level. So you would have not traded this anyways. But this is just a way of understanding. I use this as a way to understand the market and not take trades recklessly. So for example, in this moment, I'll give an example of, let's see. Today on the NASDAQ, I was trying to take a long, where did it start? Yeah, today was a great example. The way I use ICT the most is to avoid losing trades. And that is, say I am bullish on whatever larger time frame. I check the 4-hour, I check the daily or weekly chart, and it says I should look for a long. Well, price is going down, 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 but I do not have a long because it's never giving me a fully bullish market structure break. You can draw your highs off of all of these levels here. What am I on the mark? The 15-minute. And this is going to save me from taking a losing trade long all day. Well, this is counting yesterday too. But basically, what do I look for in order to take a long? I would need a low to get broken and then a high to get broken. So in order for me to go long, I would need price to get below this level and then get above this level and then retrace and then go. But that doesn't happen all day. Look at every single pullback that happens, it just never gets broken above. This is internal, so that doesn't count. So all day long, I'm looking for trades. No break above, no break above. At the very least, I avoided however many losing trades by just watching market structure and drawing it like this and saying, okay, I do not look for a long until price smashes one of these levels. And it doesn't do it all day. Actually, it did do it on the 5-minute time frame, and that's actually when I finally took trades. Now, TradingView is not plugged in, but this is when I finally took trades because it actually had some structure breaking. Let's see, where was it? I guess I counted one of these as a, we had a bunch of up candles and it was getting really messy. So I got impatient and I called this, I bent my rules a little bit. Well, not really, but I called this a high. And then I noticed that in general, price had been respecting these golden pockets. I went all the way down to the 1-minute time frame. There it is. And then I noticed that price was respecting these golden pockets on all these different levels. So by the time price got here, I was just longing it at my stop loss somewhere around here below this level or in the middle. And I just longed it to the top of there. Because all day long, you barely had any breaking I think I took a 1 or 2 losing trades when on the 1 minute time frame it broke above one of these levels, and then I said, no, I'm doing the 5 minute time frame or the 15-minute time frame or whatever, and that didn't happen until it got all the way down here.
Mm-hmm.
But I was way up on the day because you take 1 or 2 losses, and then forget, I was doing pretty tight on the risk reward, but it was like oh no, because I took it all the way up here to this one. Yeah. Some of the trade I closed at this, and then I let the rest of it run up to this level. But I can take, if I've got a 4.0 risk reward ratio, I can take 3 losing trades and then take 1 winning trade, and 4 minus 3 risk factors is still 1. So if I'm risking $100 every single time, and I take 3 losses, I'm down $300. And then I take 1 win, I'm up $400. So I'm up $100 on the day. And you can do that same math. Does not matter how big your account is. You can do that same math with $10 or $1. That is all that matters, is waiting for the break of structure, waiting for the market structure shift, it's called. But again, I hate terminology.
Mm-hmm.
And then waiting for the pullback. And you do it at the right level. I think on the 4 hour, where are we? Yeah. See, look at that. 4 hour chart. And bam. There it is. So I'm in discount on the 4 hour. I think this counts as a daily as well. Yeah. I'm a discount on the daily, the 4 hour. And then now the 1 minute or the 15-minute, 5 minute is giving me a little bit of bullish reaction there. But that's it. How do you know how and where to plot those fib settings for the equilibrium and golden pocket? The fib settings are, the fib tool just takes some getting used to, because it depends on what direction you draw it. Like if you drag it from up to down, it goes one way. Or if you drag it from down to up, it goes the other way. And you can use the fib tool in either direction. And you can use the fib tool for all sorts of different purposes. But for example, I just want to see what Bitcoin's doing just for fun. Oh, yikes. Zappy, zappy. So for example, on these trades here, did I do that all the way earlier? Yeah, there it was. That's the trade that I was looking at earlier. I'm on the 1 minute time frame, but I know that on the 4 hour time frame, this level right here is important. This is a 4 hour internal high. So that's the missing last key of how to not take a bazillion trades and lose all your money, is you wait until the very specific levels get hit, either equilibrium or a high or a low or the golden pocket. And so this was a 4 hour internal high. And even on the 1 minute time frame, you see this high get put in, this high gets created, and then it creates a low here. And then it tries to go above this high, but gets absolutely slapped back down and breaks. It does get above this high. So this counts as a market structure shift. Then you can carry this out, but I prefer to just use the fib tool. Then the way I use the fib tool for drawing premium and discount is you always have to drag from the bottom up. You start at the low, you drag to the high. Because I don't have these labeled with 0.618 or whatever, I have them labeled manually as, so let's call it range 5 minute. So if I were to draw this from the top down, it would put discount up above and premium down below, which is obviously just not right. But I've sketched these out with the text tool by adding text. And so I've labeled premium as the 618 and then equilibrium as 0.5 on the fib. And like I said, I'll post this data in the private Discord. But then I've listed premium. So for a short, because it broke like this, I'm looking for a short. For a short, I am looking for it in premium, which right there, like I said, just what you want to do is give yourself some level of leeway, and I usually put it somewhere in the middle, unless there's something specific up here that might attract attention. And then you target that low that gave it to you, and you've got your 2.0 risk reward. I'm not taking a trade unless it's at least 2.0 on the reward factor.
Mm-hmm.
But this does it real quick because on the 4-hour time frame, this was a very key level. And I bet you that on the 15-minute time frame, that can